1. Is it possible to invest with small capital at the beginning? Yes. The financial world is far more accessible today than in the past. Investing with small capital is possible both in theory and in practice. Thanks to digitalization, investment tools with low minimum balances have become widespread. Key facts. Even very small amounts, such as bank deposits, can generate compound interest/income. In markets like Borsa Istanbul, it is possible to own stocks with as little as $50, 100. Investment funds and digital banking products target small investors with low entry amounts. This disproves the myth that you need large capital to start investing. 2. How does small capital grow over the long term? Compound returns. Compound returns provide returns on returns over time. Even a small amount of capital can grow because the income earned is reinvested. This principle forms the foundation of long-term advantage in many financial theories. Example, if you reinvest your annual returns, your capital can grow exponentially over time. Time plus discipline equals capital growth. 3. Suitable investment tools for small capital. The following instruments make it easier to invest with small amounts. 1. Buy-Resell System, Private Pension System, BS. Can be started with low monthly contributions. The government provides a 30% contribution, which acts like an additional return. 2. Stocks. You can buy even a single share with a small amount. Offers long-term growth potential. 3. Investment funds/ETFs. Allow diversification across many assets with small amounts. Help reduce risk through diversification. 4. Gold/digital gold. Even small amounts can be used to buy gold. Provides protection against inflation. These tools make investing possible regardless of capital size. 4. Disciplined contributions and regular saving. One of the most important elements of long-term investing is consistent contributions. Starting small and adding regular contributions over time accelerates portfolio growth. Example, investing a small amount every month. Reinvesting gains. Strengthens the power of compounding over the long term. Disciplined contributions can be more effective than a single large investment. 5. The importance of a long-term perspective. The long term is a critical part of investment success. 1. Market fluctuations tend to balance out over time. Short-term volatility is normal, but over the long term most asset classes show a positive trend. 2. Time reduces the impact of risk. Market declines tend to recover over time. Long-term investors benefit from broader return potential. 6. Strategies to turn small capital into an advantage. 1. Start early. Growth in financial markets becomes powerful over time. Starting early transforms small savings into larger capital. 2. Invest regularly. Monthly small contributions build investment discipline and enhance compounding. 3. Diversify. Risk can be spread even with small capital, reducing overall risk exposure. 4. Be patient. Focus on long-term goals rather than short-term fluctuations. Conclusion: is long-term investing with small money possible? Absolutely yes. Investing with small capital and turning it into a long-term strategy is both theoretically sound and practically achievable. What you need: the right tools, disciplined contributions, a long-term perspective, the power of compounding. When maintained together consistently, even a small initial capital can turn into meaningful financial growth over time. But production, innovation, and economic activity do not permanently stop. Realistic conclusion: in 10 years, a disciplined, long-term investor will most likely see growth. A frequent trader will likely underperform their potential. A panic seller will suffer the most damage. Uncertainty exists, but the probabilities favor the patient investor. Final thought: we cannot know exactly what investments will look like in 10 years, but we can predict this with reasonable confidence. The biggest difference will not be created by the market. It will be created by the investor's patience.